So let's talk about a young guy named Ahmed. Like a lot of us, he's just starting his career, wants to build a secure future, and knows he needs to grow his wealth somehow. But the second someone mentions the stock market, total freeze. You know what I mean, right? There's this massive cultural fear around it. We hear the word stocks and instantly picture absolute financial ruin, like that cinematic stereotype of a guy losing his life savings overnight. But I want you to step back for a second and ask yourself, is that actually the reality, or is it just a dramatic myth? Today, we're going to strip away all that anxiety and complexity in this explainer. We're breaking down exactly how the stock market works, step by simple step. Whether you've got a little bit of savings stashed away or you're just super curious about how wealth is actually built, I promise you, by the end of our time together, you're going to see the market not as this big, scary monster, but as a mechanism.
So let's address the elephant in the room right off the bat. Is the stock market really just a highly efficient way to lose your hard-earned money? I mean, for a beginner like Ahmed, is throwing in a small amount of capital just a massive, terrifying risk? For decades, people have treated the market like this exclusive VIP club, where only billionaires win and everyday people just get crushed. But what if I told you that with the right structure, a bit of focused learning, and a really solid strategy, even tiny amounts of money can start generating real returns? Let's dismantle this myth together. Okay, let's dive into this. Here's our roadmap for today. First, the stock market myth. Then, how companies get funded. Next, a brief global history, followed by 3 steps to start. And finally, managing your portfolio. All right, section 1, the foundation. Let's look at how companies get funded.
Before we can really grasp the stock market, we kind of need to flip our perspective. Instead of looking at it as an investor, look at it as a business. Ask yourself this. Where do massive companies actually get the mountains of cash they need to build new factories, hire thousands of people, or buy cutting-edge equipment? Well, when a business needs to raise serious capital to expand, they basically have 3 main doors they can walk through. Door number 1, getting a bank loan. Door number 2 is issuing bonds. And door number 3, and this is the big one, is issuing shares.
Think about it. If a company goes to a bank for a loan, sure, they get the money, but they also get chained to high interest rates, which creates immense financial pressure. If they stumble on their payments, boom, bankruptcy. Issuing bonds is kind of similar. The company gives you a certificate, you give them cash, and they're legally on the hook to keep paying you a fixed interest rate. It just piles on their expenses. But issuing shares, that is brilliant. Instead of borrowing money and just drowning in debt, the company turns to the public and says, hey, come partner with us. Share the ownership. By issuing shares, they get the exact cash they need for that new factory, but without taking on a single drop of crippling debt.
So the absolutely crucial point here is understanding what a stock actually is. Imagine a massive, well-known company. Let's say Telecom Egypt or Talat Mustafa Group. When you buy a stock or a share, you aren't just moving digital numbers around on a screen, no way. You are literally becoming a partial owner of that real-life business. And the beauty of this partnership is the alignment. If Talat Mustafa Group uses that funding to build more real estate, sell a ton of units, and generate huge profits, you profit right alongside them. As the company's total value shoots up, the value of your specific piece of the pie generally rises too. Moving on to section 2, the origin. Let's do a brief global history. Now, a pretty logical question pops up here. Let's say you've bought a share, you're a part owner of a growing company, but what if you suddenly need your cash back next month? You can't exactly knock on the CEO's door and demand they sell a piece of a factory to pay you out, right? Investors needed a way to trade their shares with other people quickly. And that, my friends, is how the stock exchange was born. It actually all started way back in the city of Bruges, inside a hotel owned by the Van der Burser family, where European merchants would gather to trade. That wildly successful idea spread like wildfire to form the London and New York stock exchanges. And by 1861, this highly structured system made its way to the Middle East with the historic opening of the Egyptian exchange in Alexandria. So you see, it's not a casino. It's a time-tested, incredibly stable structure built purely to help people buy and sell their ownership stakes safely.
Which brings us to section 3, the playbook, 3 steps to start.
Let's jump back to our beginner investor, Ahmed, and follow him as he takes 3 essential steps to enter the market safely. Step 1, he absolutely must choose a reliable broker. Step 2, he cannot, under any circumstances, put all his eggs in one basket. And step 3, he has to learn the actual mechanics before investing a dime of real capital. Let's break each of these down.
All right, step 1 is securing a broker. As a beginner, Ahmed can't just casually stroll into the stock exchange and start buying shares directly. He needs a legally authorized intermediary.
So he carefully selects a trusted brokerage firm, submits his official ID, signs the trading agreement, and officially opens his account. In return, they assign him a unique trading code and give him a secure electronic trading app right on his phone. This app is basically his gateway to the whole shebang. The broker's entire job is to execute his buy and sell orders safely and accurately.
And this brilliantly illustrates our next vital concept, diversification, which is step 2. Imagine Ahmed has a set amount of cash. A truly terrible strategy would be taking every single penny and dumping it into 3 different oil companies. If the global oil sector takes a sudden hit, his entire portfolio crashes. That is a massive, unnecessary risk. Instead, a smart, healthy portfolio spreads that capital out across entirely different sectors: pharmaceuticals, banks, telecom, manufacturing, and oil. This is exactly how you shield your hard-earned capital from total loss. Because look, if one sector struggles, another one might be booming, which balances things out and protects your overall investment.
Then we hit step 3, learn first. You have to understand the massive difference between true long-term investing and day trading speculation. For a beginner, rapidly buying and selling stocks every single day is essentially just gambling. Long-term investing, on the other hand, actually relies on the real-world growth and profit of the underlying businesses. So, before risking his actual savings, Ahmed is smart. He takes advantage of demo accounts provided by his trading app. These are amazing because they let him practice trading with virtual money, observe the market movements, and build his skills in a completely risk-free environment.
Okay, section 4, maintenance, how to manage your small portfolio.
So, let's say Ahmed practiced, diversified properly, and finally bought his very first shares. What happens now? Well, he needs a regular maintenance checklist to review his performance. To manage his small portfolio effectively, he's got to ask 3 vital questions. Question number 1, what stocks should I keep? To answer this, he learns to look at simplified financial statements, like quarterly income reports. It's not rocket science. He simply keeps the strong companies, the ones whose core businesses consistently show stable, reliable profits and steady growth over time.
Question number 2. What stocks should I sell? Now, this one requires taking your emotions completely out of the equation and letting the data drive the decision. If Ahmed checks those simplified financial statements and spots a company with consecutive quarters of losses, declining indicators, or deep structural issues, he's got to be willing to let those shares go. Selling off underperforming assets is a vital part of protecting your capital. You absolutely cannot hold onto a sinking ship just hoping it'll magically turn around. And finally, question number 3, what stocks should I buy next? As he manages his portfolio, Ahmed is always kind of scanning the horizon for companies that are showing really strong future growth potential. By consistently asking these 3 simple questions, what to keep, what to sell, and what to buy, maybe on a monthly or quarterly basis, literally anyone can graduate from being a complete beginner to becoming a strategic manager of their own financial future.
Which leads us to our final part, section 5. The golden investing rule for beginners.
Stepping into the shoes of a financial advisor for just a second here, I need to leave you with the absolute most crucial piece of advice to protect your initial capital. Never, ever invest all of your savings at once. Look, I know it is incredibly tempting to just jump in with both feet when you're excited, but you must start small. Investing is a gradual process. By putting in just a tiny amount initially, you're basically giving yourself permission to make those inevitable beginner mistakes. And making a small mistake with a tiny portion of your capital, that is exactly how you gain massive, invaluable experience without facing total financial devastation.
So the crucial point to remember is that investing is not a sprint. It's a long journey. Real wealth building takes patience, education, and a solid long-term strategy. And a big part of that is understanding the essential difference between fundamental analysis and technical analysis. Fundamental analysis is when you're looking at a company's actual health and simplified financial statements to make sure it's a genuinely solid business. Technical analysis, on the flip side, is looking at short-term price charts and trends. For a beginner who wants to build sustainable wealth, do yourself a favor and focus deeply on those fundamentals.
Well, we've completely demystified the market today. You know what shares actually are, how the exchange works, why you need a reliable broker, and the golden rules of diversification and starting small. So I want to leave you with a challenge right now. If you had your first 10,000 Egyptian pounds to invest today, using everything we just talked about, what exactly would you do with it? Think about your strategy, do a little research, and take that first educated step towards your financial future. Thank you so much for joining me for this explainer, and keep learning.